Welcome back. And in our top business story, the drop in global oil prices to more than one-year lows will not have any near-term impact on GCC fiscal surplus and net foreign assets that are respectively projected to be at 8.3% of the region's gross domestic product at $2.34 trillion. The UAE, irrespective of a projected slight drop in value of oil exports, is well on track to record a fiscal surplus of 8.8% of GDP in 2014, above the GCC average, as its net foreign assets are estimated to hit $510 billion, the second highest in the region after Saudi Arabia's projected at $1.06 trillion. Energy analysts have made the largest downward revision to their oil price forecasts in almost 2 years, with a marked weakness in the price of Brent seen persisting into 2015. The Institute of International Finance in a recent report has said that assuming an average Brent oil price of $105 per barrel in 2014 as compared to $108 per barrel in 2013, the GCC's external current account surplus, while declining, is expected to remain large at $287 billion in 2014. Consequently, the value of hydrocarbon exports from the GCC is projected to ease further to $693 billion in 2014. Lower hydrocarbon export receipts have also meant lower fiscal revenues, projected at 41% of GDP in 2014, down slightly from 43% of GDP in 2013. Fitch Ratings has cautioned that the ratings of GCC privately owned corporates are being constrained by relatively weaker corporate governance than the developed market peers. The ratings agency said in a statement that this is mainly due to the absence of an effective independent board, weak transparency and limited disclosure practices, but added that corporate governance practices are steadily improving in the GCC, largely in relation to publicly listed companies, with both UAE and Qatar recently having undertaken regulatory reforms to move into emerging market status. Fitch went on to say that for privately owned corporates, a move in company culture toward more independency, transparency and disclosure could still take some time, especially for privately owned corporates that have yet to adopt these practices on an optional selective basis. Fitch claimed that lagging governance standards can discourage international investors from looking for opportunities in the GCC as they face closely controlled company ownership and general lack of transparency. Middle East carriers reported the strongest year-on-year traffic growth in August at 11.7%, according to the new figures released by the International Air Transport Association. According to a statement by the IATA, airlines in the Middle East continued to benefit from the strength of regional economies and solid growth in business-related premium travel. The Aviation Authority added that capacity rose to 10.3% and load factor rose 1% to 83%. Globally, IATA announced that passenger traffic results for August showed a slight pickup in demand over the previous month. Total revenue passenger kilometers increased 5.9% compared to August 2013, which was above the 5.4% year-over-year increase recorded in July. August capacity climbed 5.5%, with the load factor standing at 83.9%, which was a 0.3% rise over August 2013. And Emirates Group's Dnata will start construction on a new cargo terminal at Al Maktoum International at Dubai World Central in the second quarter next year, according to local reports. John Conway, the Senior Vice President of UAE Airport Operations, was quoted as saying that the terminal is in the final design stage and could have an ultimate annual capacity of between 1 and 1.6 million tons. Initial proposed capacity is 500,000 tons a year, and construction on the modular designed terminal would be completed by the end of 2016. Dnata will also be spending around 20 million dirhams for ground support equipment and lounge development for Dubai International's new Concourse D, which will open next year and will take the airport's annual capacity from 75 million passengers a year to 90 million. The new Dnata terminal will be used to handle cargo from other airlines landing at DWC. The announcement follows the opening of a dedicated terminal earlier this year for Emirates Sky cargo operations at the airport, located in the south of the Emirate. Emirates DWC cargo terminal can handle 700,000 tons of capacity a year, according to previous statement from the airline, and has the potential to be expanded to 1 million tons of annual capacity.